to be not with you in person and only joining you virtually, but unfortunately, I do have a few budget meetings this afternoon. I should reassure you they're internal budget, not budget with a big B meetings, which I don't get to see much of until the 26th of November like everybody else. So what I wanted to do today is offer a few remarks, maybe more from a Bank of England perspective, and in doing so, I'm going to complement what my former colleague as a member of the MPC, Jonathan Haskell, is going to say. As I'll make clear in a moment, I only rejoined the bank in the autumn of 2021. That was quite an interesting period to rejoin the bank, I have to say. Some of the issues that have been raised this morning predated my membership of the MPC, not all of them. And so what I will try and do is focus a little bit on how I interpret that period, and in particular on what lessons have been drawn from that period, and how I think the bank and the MPC may be thinking about how it should and can incorporate some of the thinking that we've heard already this morning into its deliberations. Or to put it another way, I think for a conservative institution like a central bank, and in many respects the Bank of England is the archetype central bank, I think conservative institutions probably are likely to put a weight on what Tim called in his presentation the mainstream model, and I think that is certainly true. A lot of the analysis presented to the MPC, a lot of the publications of the MPC or the bank do rely or are based on that mainstream view, of which Tim was quite critical, or very critical in fact. I have to say that I think there is a stream of thought inside the bank, and I would like to associate myself with that, but I know Ryland is with you, and he has been at the bank longer and more compellingly than I have. I think that is quite sympathetic to some of the arguments that we've heard this morning. And I think it does seem to me on an empirical basis there should be, and is, I think, to some extent, a role for broad money analysis in the assessment of the policy decisions and inflation outlook. I think, as Tim said, a big part of that role probably operates through asset prices and financial markets, which is not something that is central to the dynamics of the three equation mainstream Woodford-style model. I spent, as Juan said, more than a decade of my life working at the ECB in the 2000s. I was a proponent then of what was called the monetary pillar of the bank ECB's assessment or strategy for monetary policy. I think the demise of broad money analysis in central banks is something that probably needs to be addressed. And I basically agree with the arguments that we've heard this morning already, that the experience between 2020 and now are ones that probably provide quite a lot of empirical evidence in that direction. But I think there is still an open question, and maybe what we just heard from Dr. Greenwood is one answer to this, but there's an open question of, yes, we should be looking at broad money, but should it be the only thing we look at? I don't think that's what people are arguing, but I'd be interested to know this afternoon in the discussion whether people want to argue in that sort of relatively extreme way, as I would see it. But if we're not just going to look at broad money, then I think there's a question of how you incorporate broad money analysis into a wider set of analytical exercises supporting monetary policy, which might include exercises based on the mainstream model, but not the mainstream model alone. So what I thought I'd do is just run through some facts initially. These are well known to this group, I'm sure. I don't want to steal Jonathan Haskell's thunder or drop him in it, so I will make a few points. But as you can see in this chart, I do have a line not just for the onset of COVID, but also for the moment that I joined the MPC. So Jonathan will definitely be in a better place to discuss what was going on in the decision-making process to the left of that line, and I'll try and say some things about what was going on to the right of that line. So, as you all know, inflation rose very rapidly in the second half of 2021 and into 2022, and peaking at over 11%, which obviously is unacceptable given our target of 2% at the bank or for the MPC. what this chart also shows is the core inflation as well as headline inflation. The core measure here is an ex-food, ex-energy measure. So you can see that there was quite a significant blip from 2022 onwards associated with higher food and energy prices. But I think a number of points that have already been made, namely that the rise in inflation to above target levels preceded the invasion of Ukraine, and the fact that after the energy prices corrected quite substantially in 2023, nonetheless, you have seen inflation persist. Certainly, if you look through the base effects, or you focus on core inflation, inflation has persisted now for quite some time at above target levels. Now, of course, there is a debate about what the bank did about that, and whether it should have been tightening monetary policy by raising interest rates more early in the face of that rise in inflation. When I joined the bank in September 2021, we did move to tighten policy relatively quickly, maybe not quickly enough. So I think there's a question of whether policy should have been tightened perhaps earlier than that period. And I think Jonathan will have things to say about that. So I wouldn't want to front run him, although of course I would recognise that at the time of the pandemic, there was a high degree of uncertainty, and probably that influenced policy making quite significantly. But what I would say, which I think is relevant to this discussion, is that the fact that we had done, or the bank had done QE earlier, did lead to quite a long discussion about what role forward guidance and the sequencing of exit from the very ultra easy policies that have been introduced in 2020. And I think that did play a role in delaying the promptness of the interest rate response. So the bank had spelled out that it would cease to do asset purchases before it began to raise interest rates. And I think that fact that asset purchases have been announced through to the end of the year probably did delay, on my reading, a little bit of the rise in interest rates subsequently. So I think one of the things I would take from this is, whether it's through forward guidance or this type of sequencing type of story, I would say that central banks probably don't want to tie their hands too closely with regard to policy tightening. I think a certain amount of flexibility and emphasising the conditionality of those statements, if circumstances change, then policy may need to change, probably is something we should take away. And I think some of the communication of central banking community in general has gone in that direction subsequently. But let me just pick up on points that were made about QE. So, I mean, this is just simply reporting, and you can see between the onset of the pandemic in 2020, we saw a very substantial increase in the balance sheet that was driven by asset purchase, by QE, effectively. And as has been said, and I think the points made around were the assets being bought from non-banks and so forth are important points. So I will not go and repeat that discussion, but I do think there are some issues there that perhaps are worthy of further discussion. But nonetheless, a conscious decision by the Bank of England, to expand its portfolio of assets held for monetary policy purposes, its QE portfolio, led to an expansion of the bank's balance sheet. But, and I think in the context of the discussion today, more importantly, okay, well maybe I'll talk to this one. So, I mean, I think this is the key slide, I think, from the discussion we've heard today. So this is the ratio of broad money to nominal GDP. So it's a sort of version of velocity in a sense. And we show here two measures, M4X. So that's been discussed. Ryland is with you to discuss the intricacies of what that specific definition of money. I do think it's quite telling that our baseline measure of money, broad money, has such a complicated name, because it's not just M4X, it's M4X IOFC, which stands for M4 excluding intermediate other financial corporations. So I do think there's an important set of measurement issues here, that we do need to make sure our definition of the monetary aggregates and our statistical base for the monetary aggregates is kept up to date. And changes in the structure of the financial system and the structure of the banking system are well represented in how we construct our monetary aggregates. So I think that's an important set of issues, which again, perhaps are not to dwell on here, but for further discussion. But what's apparent is, coincident with the onset of the pandemic in 2020 and the introduction of QE in the form I just described in the previous slide, you can see that M4X relative to GDP spiked up well above long-term trends. So we created a big money overhang. What's also interesting here is that initially the bulk of that monetary overhang was created in the private sector that wasn't the household sector, and that was largely in financial corporations. So I think that does inform Tim's point earlier on that a big part of the transmission of the monetary impact of QE and broad money expansion is taking place through asset markets and financial markets, not just through households directly. But what you can also see is more slowly, household money overhang also built up. So I just want to make kind of 2 points here. One is there is a big spike in 2020 associated with what at the bank is called the dash for cash. So disruptions in financial markets led a lot of asset managers to seek safety in the form of holding cash, be that bank deposits or central bank reserves if they had access to the central bank balance sheet. So that creates a spike which might be seen as a more demand-led phenomenon for money. But of course, once that money has been created by QE, it stays there, it doesn't disappear. And so it only slowly erodes, and that erosion of that monetary overhang was certainly an inflationary process in the UK. And you can see that money that was created in the non-household part of the private sector seeped into the household sector and probably supported spending in the way that we heard from Dr. Greenwood in the previous presentation. What I think is interesting, though, also, is that if you look at real consumption, so this is consumption volumes for households, they spiked down with the onset of the pandemic, unsurprisingly, because people couldn't go out and spend money. But actually, despite the fact there was this money overhang, what we did not see during the recovery, if you like, from the pandemic, is that that money overhang was ended up in higher volumes of real spending. So the erosion of the money overhang here, shown here, is pretty much driven by higher inflation. So there was a debate back in 2021 about was there going to be a consumption boom as this household broad money overhang was spent down. We never saw that consumption boom, but what we did see was higher inflation. And I think that does get to the fact that some of the exogenous factors, maybe the rise in food and energy prices, they were accommodated by the monetary overhang rather than leading to higher volumes of domestic spending. So that's how I would sort of characterize the facts of the situation. Let me make sort of 3 points here, which I think are the points I would emphasize in understanding the way the Bank of England kind of addressed this question. So just to go back to this point, I think in March 2020, when the initial COVID impact happened, my understanding, Jonathan will also talk to this, my understanding of what happened is the immediate impact was we saw dysfunction in financial markets, particularly in the gilt market. And that was not unique to the UK. We saw dysfunction in treasury markets in the US and in sovereign markets in many of the advanced economies. So there was a sort of financial stability issue that core funding markets for the government and for other actors in the economy were drying up. I think the Bank of England stepped in to try and re-liquidify those markets. But the fact is that the only real active tool the bank had to do that was a monetary policy tool. It was QE. So there is a sort of question about what happened in the early spring of 2020 was there was a financial stability or market functioning problem that was met with a monetary policy instrument. And that does go to some of the things I think was said earlier around the success of QE, and I think it was a success in the face of the financial crisis in 2009, 2010, where it also addressed, to a large extent in my view, financial market disruptions. That perhaps gave reason for a somewhat complacent view of how QE could work in the face of those disruptions. So I sometimes think that, central banks like the Bank of England, they had a hammer which was QE, and when there's a hammer that's QE, every problem is a nail. So every problem is one that can be solved or addressed like the way the 2009-2010 problem was addressed. And some of the rhetoric of the central banks in the middle of the 2010s decade of monetary policy needed to be the first responder to many problems, even if they weren't fundamentally monetary or inflation problems, or that given the needs to sort of bring out the big bazooka to have very assertive, it was better to crack a nut use the sledgehammer to crack a nut, to err on the side of doing too much rather than too little. And of course, when you're confronted by a problem that isn't a nail, that type of thinking may lead you to do too much and create problems from a monetary point of view. And I think there is that narrative, that story is probably one that has some validity to it. So what have we done in response? I mean, I do want to emphasize in the forward-looking sense we have learned some lessons from this. Well, we had another dysfunction in gilt markets, as you all know, in the autumn of 2022. That was in a different setting where inflation was already rising. We were planning on reducing the portfolio of gilts by doing QT operations, selling gilts. We postponed those selling of gilts, and we did buy more gilts in order to support market functioning. But I think crucially, we did not brand those purchases as quantitative easing. We branded them as financial stability operations. And the different feature there was those financial stability operations were timely. They were intended to be quick to address the immediate problem in financial markets. They weren't intended to be lasting. They were temporary, so they were designed to unwind quickly rather than be more buy and hold operations like the QE operations that we'd preceded had been. And they were targeted on where the dysfunction in the market was happening, which was particularly in the indexed long-dated end of the yield curve, where the pension funds and LDI funds were operating. And I think crucially, that allowed those operations to be unwound very quickly. So at the time, in 2022, I think the form of the operations was different. And as you can see from this extract from a letter that then Deputy Governor for Financial Stability wrote to the chair of the Treasury Select Committee, it's not just that we did these operations to stabilise markets and they were temporary and targeted, but it's also that we announced at that time that we would monitor monetary trends in the aftermath of these operations to ensure that we did not create the type of monetary problem that followed from the 2020 interventions. And I think if you look in the minutes of the MPC in the autumn and winter of 2022 into 2023, you will hear, relative to the preceding minutes, quite a lot of discussion of M4, quite a lot of discussion of how bank balance sheets were adjusting, and quite a lot of emphasis on the fact that the additional asset purchases that had been made had been withdrawn relatively quickly. So, my take from this is there was a lesson drawn from the experience of 2020, and the bank has tried to introduce a different type of operation with a different form, and is monitoring it in a much more monetary, broad money analysis way in order to avoid some of the issues that have emerged as a consequence of 2020. Do I think that monitoring, do I think those operations are all perfect? Well, I think only time will tell. But I do think there is a different regime in place, and that's an important thing to emphasize. So then going back here again to this chart, I think you can see that was perhaps explaining the initial spike in 2020, the phenomenon I just described. But then, of course, the money overhang in general, and particularly in the household sector, is much more lasting. And I think that might be associated with the decisions surrounding a further expansion of QE in 2020. Now, by that point, the dysfunction in financial markets had eased. Markets had largely stabilized. But it was perceived at the time that there remained macroeconomic risks that needed to be addressed by monetary policy. And in particular, the overwhelming sentiment, as I understand it, and I would imagine Jonathan will speak to this in his remarks, was that the balance of risks to the inflation target was to the downside, despite the high level of money. And there was a need to buy some insurance against the possibility that the economy during the pandemic tipped into a very deflationary state. So that, I think, with the benefit of hindsight, was a misdiagnosis of what the problem was. So whether the QE was at the heart of the problem, or whether it was the misdiagnosis, I think is quite an interesting question. So if we had ended up starting that period with higher levels of interest rates, and we cut interest rates and maybe stimulated the economy and stimulated broad money growth through lowering interest rates rather than doing QE, would that have been a different outcome? I'm not sure it would have been. I think the problem there was not the QE. The problem was the diagnosis of what the issues in the economy were, where they emphasized weakness of demand, whereas in fact there had been a disruption to supply, and they underemphasized the stabilizing effect on spending of the money overhang in the household sector, which had been created as a result of the QE. I think they probably underweighted some of the magnitude of the fiscal issues a little bit in the spirit of what Tim was saying earlier. So you can see some of that in this chart. So what this chart is sort of taking the lens of the mainstream model. I don't want to upset people with that, but what it says is not just that money was too high, but if you look at what the view of the slack in the economy, the output gap, these concepts that are sort of central to the mainstream model, you can see that negative numbers here mean that what was assessed by the Bank of England or MPC in real time meant there was more slack than what we currently think was the level of slack in that period, if the number's negative. And you can see from 2020 to 2022 and beyond, both in the space of output, so goods and services, and in the space of unemployment, there's very systematically the view that the MPC was told by the staff of the bank, there's more slack in the economy than we currently think there was. So I think it was that view that, oh, demand is weak, but supply is still there, when in fact, demand was more sustained, partly by fiscal measures, partly by the strength of the money growth and the money overhang. And in fact, it was that supply was weak at this time, owing to some of these supply chain disruptions and so forth. So the imbalance that we now see that drove inflation higher was underestimated at the time. And I think, again, in that context, monetary dynamics certainly had a role to play in explaining the maintenance of demand strength, even in the face of this supply weakness. So I think the question then is, as we look forward, what lessons have we drawn from that, and how can we implement them in our policy framework? Well, of course, that really gets to the question of, can you diagnose where you are better? And that the role for broad money in that does come back to, exactly as Professor Hankey was saying, is can you rely on the trend stationarity of velocity such that you can interpret movements in money as being ones that will reverse or not through time? And I think there, this is work that has been done by Ireland and has been presented in the bank's monetary policy report. I think at the higher frequencies, so short-term cycles, there is quite a lot of noise in broad money, and its relationship with inflation at sort of higher frequencies, shorter cycle frequencies, as reflected in the left-hand chart here, is a complicated one. But as you focus more on trends, the lower frequency movements, as reflected in the left-hand side, you see that proportional relationship, that quantity-theoretic relationship, begin to reassert itself. So I think one of the challenges is how to translate the sort of stability reflected in the left-hand chart, that strong money growth does drive higher inflation, how that can be extracted from real-time data, where that real-time data is quite noisy owing to the sort of volatility you see in the right-hand chart. And that's remaining an outstanding sort of practical, empirical, econometric issue. I do have sympathy with what's been said this morning, and this was the essence of what the ECB was doing 20 years ago, is that there is a danger because in the short term, the right-hand chart tends to dominate discussions and doesn't seem useful. You neglect the left-hand chart. And so having some sort of cross-checking device, some sort of commitment to look at low-frequency movements in broad money and say, when you end up with an overhang that looks as big as this, you should at least be worried about its implications for inflation going forward. I think ensuring that that is part of the standard analytical inputs to MPC decisions seems to be important. And I think that gets back to the question of Juan's referral to Jay Powell's comment. There's a famous comment from a little bit longer ago of a former governor of the Bank of Canada who said, we did not desert the monetary aggregates deserted us. But I think that probably misses the importance of this low frequency relationship. So one of the things we are trying to do at the bank is, from a period of the inflation report back in the late 90s, early 2000s, where there was a long section about money and credit developments in every inflation report, That had all but disappeared by the time we got to the middle of the last decade, where I think the focus of the monetary policy report, the successor to the inflation report, was almost exclusively on the inflation forecast based on the mainstream analysis that Tim was criticising. Thanks to the work of Ryland, who's with you, and others, we have now tried to introduce a regular box where charts of this type have been presented. I mean, this is a very similar chart to what you see in Tim's latest book. And by having a box, maybe at a lower frequency, an annual box in each May, that's what we've done for the last 2 years, I think that's something which pushes the MPC to at least confront these issues. And if they're giving the messages that are akin to the ones we would have seen here, I think they would have been incorporated into the overall policy thinking earlier, just because there's a disciplining effect from having this robust, simple analysis, but often monetary policy is about doing simple things well rather than complicated things, even if the academic return to complicated things is often high. And then finally, I just want to conclude by saying that use of these boxes, the development of more analysis of the sort of trend money growth, broad money growth type, I think that also follows from some of the conclusions of the recent Bernanke review. So I don't think Professor Bernanke is particularly an enthusiast for broad money analysis in coming to monetary policy decisions, but I think he is an enthusiast for saying that the role of a central forecast or projection based on the mainstream framework that we heard about, that is perhaps a fragile approach to monetary policy in an environment of very high uncertainty. So a more diverse analytical approach is probably more robust and therefore better on average in the face of that uncertainty. And if we put less emphasis on the central projection or the mainstream analysis in coming to our decisions, we need to put more emphasis on other forms of analysis. And I think the type of broad money analysis that we've heard today is definitely an important candidate, which Ryland and others are trying to feed into the process. So what I want to kind of conclude by saying is, I think this exercise this morning has been a very useful one. I think the bank has learned lessons from some of the things that have been discussed already. There is a concerted effort to implement those lessons in the internal thinking and perhaps to a lesser extent thus far in the external presentation of monetary policy decisions. But at the same time, I think it's not that the mainstream analysis will disappear anytime soon. I think the broad money analysis will be a complement and hopefully an improvement upon or a cross-check of a broader set of analysis, including that mainstream analysis. So let me stop there. Thank you very much.